Unlocking long-term finance, your guide to funding the future. Hey everyone, and welcome to our deep dive into the world of long-term finance. We're not just talking about the cash for day-to-day stuff, but the big bucks needed for things like buying property, building factories, or developing groundbreaking technologies. Essentially, companies have two primary avenues to fuel their growth: equity finance and debt finance. So buckle up, get ready to learn, and let's unlock the world of long-term finance together. Let's kick things off with equity finance, the cornerstone of many businesses. Think of it like slicing up a pie. Each slice represents a share of ownership in the company. When you buy an equity share in a company, you become a shareholder, a part owner with a vested interest in its success. These profits are distributed among shareholders as dividends. But remember, with great ownership comes great responsibility, or at least some risk. Companies can raise equity finance through various means, the most common being issuing new shares to investors. This can happen through initial public offerings, IPOs, or follow-on offerings. Unlike debt financing, where you're obligated to make regular interest payments, equity financing doesn't have that pressure. Let's move on to another key player in the world of long-term finance: retained earnings. Retained earnings are like the responsible older sibling of the finance world, always thinking about the future, always planning ahead. They represent the cumulative profits a company has held on to over time, reinvested to fuel future growth. They can be used to fund a wide range of activities, from expanding production capacity to investing in research and development. The beauty of retained earnings lies in their flexibility. They give companies the financial freedom to seize opportunities as they arise without relying on external sources of funding. Moreover, using retained earnings for financing comes with a significant advantage. There's no dilution of ownership. It's about strategically using past profits to build a brighter, more prosperous future for the company. Now let's dive into the intriguing realm of preference shares, a hybrid financing option that blends features of both debt and equity. Like debt, preference shares typically offer a fixed dividend payment. However, unlike bondholders, preference shareholders have a claim on the company's assets and earnings before common shareholders. Preference shares come in a variety of flavors, each with its own unique set of characteristics. Cumulative preference shares accumulate missed dividend payments. Non-cumulative preference shares allow companies to skip dividend payments without accumulating arrears. Redeemable preference shares come with an expiry date. Irredeemable preference shares remain outstanding indefinitely. Participating preference shares offer investors the opportunity to share in any surplus profits. Non-participating preference shares provide only the fixed dividend payment. Convertible preference shares come with the option to convert into common shares at a specific price. Chapter 4: Bonds and Debentures. Borrowing from the crowd. Bonds and debentures are about borrowing money, but not in the traditional sense of going to a bank. Imagine bonds and debentures as IOUs issued to the public. Companies use them to raise capital from a large pool of investors, promising to repay the principal amount at a future date, along with periodic interest payments. Bonds with fixed interest or coupon payment. These are your classic vanilla bonds offering a fixed interest rate, known as the coupon rate, paid out at regular intervals. Deep discount and zero coupon bonds. These bonds are issued at a significant discount to their face value and don't pay any interest during their term. Eurobonds. These bonds are denominated in a currency different from the currency of the country or region where they are issued. Share warrants or options. These bonds come with a bonus feature, an option to purchase a certain number of companies' shares at a predetermined price within a specified period. It's like getting a bond and a stock option all rolled into one. Chapter 5: Bank and Institutional Loans. The traditional route. Bank and institutional loans are like the reliable friend you can always count on, providing a straightforward way for companies to access large sums of capital. These loans can be used for a variety of purposes, from financing new projects and expanding operations to refinancing existing debt. One of the key advantages of bank and institutional loans is their structured repayment schedule. Companies know exactly how much they need to repay each month. making it easier to manage cash flow and plan for the future. However, bank and institutional loans often come with strings attached, primarily in the form of collateral. Secured loans are backed by collateral, such as property, equipment, or even accounts receivable. Unsecured loans don't require any collateral, but typically come with higher interest rates to compensate for the increased risk for the lender. Chapter 6. Leasing, borrowing what you need when you need it. Leasing is like renting a house instead of buying one. You get to use the asset without the burden of ownership. In a nutshell, leasing involves two parties, the lessor, who owns the asset, and the lessee, who uses the asset. The lessee makes regular lease payments to the lessor for the right to use the asset for a specified period. Leasing can be applied to a wide range of assets, from heavy machinery and vehicles to office space and even technology equipment. One of the key advantages of leasing is that it preserves cash flow. Instead of making a large upfront investment to purchase an asset, companies can spread the cost over the lease term through manageable lease payments. Moreover, lease payments are often tax-deductible as business expenses, providing an additional financial advantage. Chapter 7. Securitization of assets, turning debt into dollars. Imagine taking a bunch of different debts like mortgages, car loans, or credit card debt, pooling them together, and then transforming them into tradable securities. Securitization allows financial institutions to convert illiquid assets like mortgages into more liquid securities that can be easily traded in the market. This frees up capital for lenders, enabling them to provide more loans and keep the financial wheels turning. These asset-backed securities offer investors a way to invest in a diversified pool of assets, potentially earning a higher return than traditional fixed-income securities. However, it's important to note that the value of these securities is directly linked to the performance of the underlying assets. Chapter 8. Private Finance Initiatives. Bridging the public-private gap. PFIs involve private sector companies financing, building, and often operating public sector projects. It's like a partnership where the private sector brings the financial muscle and expertise, while the public sector benefits from new infrastructure and improved services. The private sector company typically recoups its investment and earns a profit through a long-term contract with the government, often spanning several decades. This contract might involve payments linked to the performance of the asset, ensuring that the private sector has a vested interest in delivering a high-quality project. PFIs have gained popularity in recent years as a way to fund large-scale infrastructure projects without putting a strain on government budgets. However, PFIs have also faced criticism, with some arguing that they can be more expensive in the long run and lack transparency. Chapter 9. Government grants and assistance, free money with a catch. Government grants are like golden tickets for businesses, providing a much-needed injection of capital without the burden of debt or equity dilution. They can be used for a variety of purposes, from conducting research and development to purchasing equipment or expanding into new markets. However, government grants aren't just handed out like candy on Halloween. They typically come with strict eligibility criteria, a rigorous application process, and often require businesses to track and report on how the funds are used. Despite the hoops you might have to jump through, government grants can be a game changer for businesses, especially startups and small businesses struggling to secure funding through traditional channels. They can provide the financial runway needed to get a business off the ground or take it to the next level. Chapter 10. Choosing the right path. Finding your financial fit. The perfect financing cocktail for your business will depend on a unique blend of factors: your industry, growth stage, risk appetite, and long-term goals. As you embark on your own financial adventures, remember that knowledge is power. The more you understand the intricacies of different financing options, the better equipped you'll be to make informed decisions that align with your business aspirations. Don't be afraid to seek guidance from financial advisors, mentors, or even fellow entrepreneurs who've navigated the choppy waters of fundraising. Building a successful business is a team sport, and finding the right financial partners is crucial for long-term success. Remember, you don't have to go it alone. Outro funding the future, your long-term finance journey starts now. We've covered a lot of ground, from the ins and outs of equity and debt financing to the nuances of leasing and the potential of government grants. Remember, securing long-term finance is not just about keeping the lights on. It's about fueling your dreams, investing in innovation, and building a brighter future for your business and the world. As you embark on your entrepreneurial adventures, remember that the world of finance is constantly evolving. Stay curious, embrace innovation, and never stop learning. After all, the only constant in life besides death and taxes is change, especially in the fast-paced world of finance.